You might have seen that biscuit with that I symbol, right? These kind of biscuits you are going to buy whether we are in a recession or whether we are in a nice bull market, right? Hey guys, welcome back to the channel and welcome to another video. In today's video, I am going to talk about 3 specific points that you can follow to reduce risk when you invest in the stock market and also to diversify your portfolio. Let's get started right away with the video. Point number 1. Try to do systematic investment plan, which is called as SIP or rupee cost averaging whenever you are investing in a stock or generally in the stock market, right? What I mean is, suppose you have 20,000 rupees that you're planning to invest it in maybe 10 baskets of 2,000 or 5 baskets of 4,000. Why should you do this? Because this will definitely reduce your risk a little bit, okay? Let me pull out the chart. For example, let me pull out the chart of this company Tata Motors, as you see here, okay, and I see the maximum chart. So if you have a look at that, so the share price went to around 500 on 20th Feb, 570 on 20th Feb 2015. Again it came crashing down and then again it actually touched 550 on September 2016. Okay, imagine you had waited for this big drop, okay, but instead of buying it at these low points, imagine that you had actually re-entered the Tata Motors share price around 507 rupees and you had invested all your money at once. What would have happened is that, you know, in the next crash, which was pretty huge, almost I think from 500 it came down to 93, so more than 80% crash. So your overall portfolio would have been down 80%, right? But imagine that, say you just put 2,000 rupees even at the top point around 570 in 2016 October. Then as it kept coming down, you added 2,000 in buckets. So you're averaging it, but on the downward level. Then, right, once the next recovery has happened, you see now it's at 432. By actually doing that kind of averaging, your average price might have been around 300 to 400 instead of being that 570. As a result, right, over time when the stock recovers, you are still in profits. Whereas if you had invested all your money when it was at 570, you are still in probably 20-30% loss. Right, so this is important to keep in mind. Again, this is not investment advice. I personally have not invested in Tata Motors recently, but again, just an example where you cannot time which is the top of the market where it is going to crash. So better to do this systematic investment plan with averaging over time, okay? Point number 2, always split your investment between cyclical and defensive stocks. Let me pull out the chart of a company like Maruti Suzuki, for example. Okay, as you see here, I'll pull the max chart. So you see here the stock price has been going up, so it had a bull run between 2016 to 18, then it came down till, you know, this COVID time, and again it has been on the rise, right? So what happens in cyclical stocks is generally when there is a downtrend in the market, when there is a recession, these kind of companies like companies which sell cars will usually have a decrease in sales, or generally the demand will go down because during recession probably people are not feeling so secure with their jobs, so maybe they are not looking to buy something like a car or something. But when the market or the economy recovers, yes, they are probably willing to spend that extra money buy a car, and as a result these cyclical companies will even recover faster when we get out of a recession. Whereas take the example of defensive stocks. Again, let me share my screen and show you a defensive stock. For example, let's look at Britannia, okay? Britannia share price. Again, I'm looking at the max chart. You see here, although there has been up and downs, right? It touched a top in 2018 August, it crashed down, but as you see, it didn't crash a lot. From 3,300, it just came down maybe 20%, right? And again, it has recovered and it's still like, you know, little more stable, right? It's not having so many fluctuations to the upside or the downside. This is because company like Britannia is a defensive stock. So Britannia, right, you might have seen that biscuit with that I symbol, right? These kind of biscuits you are going to buy whether we are in a recession or whether we are in a nice bull market, right? So biscuit is probably a need for you on a regular basis regardless of the condition of the market. So as a result, these are defensive stocks because the demand is still there even in terms of recession. So when you balance your portfolio between some cyclical stock and some defensive stock, it will become nicely diversified and balanced, okay? Point number 3, always make sure whenever even you are taking profits of a stock, don't sell everything, leave a small portion out there, right? I'll give you again another example just to see. So let's say, for example, let's say Ashok Leland share price, right? And I actually did something like this and used this strategy exactly. So I got into Ashok Leland, I think around 35-36 rupees in mid-June 2014. And as it was going up and stuff, of course, I did not buy everything at 36. I bought through the dollar cost averaging method between 30 and 39 to 40 euro, right? I made like multiple investment. Then when the stock price went up and hit around 75-80, right? Around that time I sold a good amount, but I still left 20% of my shares, because if there was a further upside I could capitalize. At the same time, by taking profits I could also encash some of the money and safeguard it to prevent myself from losing those profits if there was a downturn, right? The 20% of share that I left, it went from 85 up to I think 130, 140, and I took out the rest, but still left some 10%, because if there is even further more upside, I could still benefit a little bit from that. Of course, the 10% share then lost a lot of value, but since I had already taken out 90% of my profits, so I made good money on the one hand, plus I left the 10% as such, which is still there till today. And yeah, I'm just leaving it for the long term, right? So whenever you take profits, don't take complete profits, leave at least 10 to 20% of your share, okay? I hope you enjoyed the video and would utilize these 3 strategies. I'll see you again in another video. Till then, take care. Bye.